Hello, guys. Good evening, all. I celebrate you all. Thanks for joining this call tonight. This is the voice of Ken Akure, and I'm doing this video to give confidence to a lot of people whose portfolio has been affected by this deep correction or market retracement that we've witnessed in the last 3 months. Yeah, it's been painful for a lot of people who bought at the top or who had been holding since but then didn't take profit, and this dip came and eroded most of their profit. So this video is to tell you that, hey, hang in there. It's too late for you to start selling your bags now. You've endured the month of April, you've endured May, you've endured June. Hey, the worst is almost over. So just hang in there. And the purpose of this chart is the Bitcoin all-time history index. It shows the very date that Bitcoin started trading up until now. So this is 1st of July 2010. Then Bitcoin was around 5 cents. Wow, 5 cents. Then at a point it went to as low as 1 cent. Bitcoin was as low as 1 cent. Then it has had, currently Bitcoin has had 3 bull circles. This is the first bull circle, 2011, when Bitcoin peaked from that 1 cent, peaked at around 16 cents, then had a massive correction down to about $2 or so. Then another bull cycle happened. It rose from $2 to as high as $800. That's incredible. Yeah. No, actually rose from like $2 to as high as $1,200. Yes, in 2013. Then crashed to $200. Then rose in from $200 to as high as about $20,000 in 2017. Now, what I want to point out is, if you notice this bull cycle top where Bitcoin peaked in 2011 and where it peaked in 2013, it never got, even when it retraced deeply, as deep as 80%, it never got to retest the peak or the top of this bull cycle of the previous year. The same thing happened here. It never dropped back to this top of the previous bull cycle top, which is what you call a bull cycle top. So it has never happened before. So now the question is, what is the probability now that Bitcoin will now drop from 34K right now down to 20,000 naira? The probability is low. Why? Because looking at the pattern that Bitcoin has set in the past of it never retesting its bull cycle top. So right now, in the 3 times that it happened before, it never came that low. So you have 3. Now it's happening at the 4th time. An extra 1 plus 1. This is the 4th time. So now you have a total probability of 4. Then 3 equals to no retest. So now you're calculating the last one, which is 1. So will there be a retest or no retest? So if you do a simple ratio or a simple probability calculation, you have 3/4 for no retest, then 1/4 for retest, So you have 3/4, 3 divided by 4, which gives you 75%. So there's a 75% chance that Bitcoin will not drop and get back to $20,000 based on the precedent or the pattern that Bitcoin has set in the last 3 bull circles. Now Bitcoin is on this 4th bull circle, and as you notice, the bull circle is like a wave that keeps getting bigger and bigger. Now I'm going to compare these charts to another chart and tell you guys what you guys think from what you're seeing. Now 3/4, then probability that Bitcoin will not get to 20K. Then the probability that it will get to 20K is, let's say, 1 divided by 4, 25%. So if you're going to make a choice based on this probability, which one would you pick? I mean, it's no brainer. You don't need to think about which decision to make. It's already clear that Bitcoin hasn't done this before. So if it does this now, it means Bitcoin is doing something very unusual. And at that point, we should all be careful, But based on this, I can tell anybody that the worst is either over or almost over. I don't see us going to 20K. Now, looking at this chart, I want to show you guys another chart, then compare. Why? Because Bitcoin is modeled to follow this chart. And that is the chart of the DJI, the Dow Jones Industrial Average. Now, this is what it looks like. Let me see if I can put them side by side. Okay. Anyway, so we have to make do. I don't know. It's not allowing me share. So this is the Dow Jones Industrial Average. It has so much history that I have to zoom out to make it this tiny for you guys to see. But then this chart has about data since 1897. So right now we're looking about 130 years, 130 years worth of data. Now, the DJI is the Dow Jones Industrial Average and is an index of the top 500 US companies in the United States, the stocks of the top 500 companies since 1897. So over time, no matter the corrections that happened, like you see here, this chart only went up overall. Yes, there were massive pullbacks, massive pullbacks, massive pullback. But overall, this guy has only been going up. And now there's a reason for this, but I cannot explain it now. Maybe we'll do a video the other day. So now based on this, what should you now be thinking about Bitcoin? Now, this has 130 years history. Bitcoin, on the other hand, has only about, where is it? Okay, Bitcoin, on the other hand, has only about 10 years, about 10 years, 10 years history. So now compare this chart. Compare this chart now. This is the chart of Bitcoin. Compare it to the Dow Jones chart you just saw. This is just 10 years. So imagine how much more room this guy has to go up. And believe you me, I can tell you this for free, that in the coming years, this Bitcoin chart will be like this. Why? The modeling is the same. The stock market is designed to give you what is called store of value and growth of value, meaning growth on value. You have money invested in the good company. As the company keeps producing and making profit, more and more people keep buying their goods and services, then the share price of that company will increase. That is how the US economy is designed. That's how the stock market is designed. Now, the cryptocurrency market is designed after a similar concept. So as more and more people keep using Bitcoin and believing in Bitcoin, the bubble of Bitcoin is going to keep getting bigger and bigger. So based on this long-term outlook that you've seen from the Dow Jones Industrial Average, it will now be wise for you to play the long game. Play the long game instead of focusing so much on what is happening day to day on price. It will be better to play the long game. So now I want to tell you guys about crypto investing, the long-term strategies. Now the market has been ranging and a lot of people are waiting for a breakout, waiting for that. And I'm here to tell you that sometimes when you wait too much, it gets too stressful. you get too stressful. So begin to think long term, begin to come up with strategies that you can use that will reduce your anxiety, reduce your fear, and still get you doing what you should do. Now, this is a quote. Uh, this interview is actually on YouTube. Maybe I'll send the link to you guys later. So this design was gotten from that interview. So in that interview, it was an interview between Jeff Bezos and Warren Buffett. Now, if you know Warren Buffett, he made all his billions out of investing in the stock market. Nothing else. Nothing else. Yeah, he actually started a company, but then the purpose is yeah, he actually the CEO of a company, but what that company actually even failed. So what the company he converted the company into a company that just manages other companies. So in essence, he didn't create any fancy product like Jeff Bezos did by creating Amazon, or like Mark Zuckerberg did by creating Facebook, or like Elon Musk did by creating Tesla. So this guy has only made his money from investing in other companies when they were not known, when people didn't know those companies even existed. That's when he was looking for those companies. So he has gotten rich over time, slowly investing in companies, most of which are listed on this Dow Jones Industrial Average. Now, Jeff Bezos asked Warren, your investing strategy is so simple. Why doesn't everyone just copy you? And of course, the answer he gave is because nobody wants to get rich slow. And yeah, think about it. Why would you want to get rich slow when you only have about max, maybe let's say 100 years to live on Earth? So, and in that 100 years, you have lots of bills to pay. You have a good life you want to enjoy. So everyone wants to get it rich, and because we have that pressure of wanting to get rich, then it makes us make certain errors, certain mistakes in our trading that end up, instead of making us money, ends up costing us a lot of money. So now, how do you solve that? You solve that by having the long-term thinking, the thinking that Warren Buffett has. Now, doing this doesn't mean if you want to trade, you won't trade. So if you have a portfolio now, you divide your money into two portfolios, one for long term, then maybe one for day-to-day trading, and you never mix the two for any reason. You don't mix the two. Now, this is what Warren Buffett has been following, the long-term investing strategy, just being in the market and staying in the market. If you ask him, he tells you that any stock he buys, he's willing to hold it forever. You know, he's willing to hold it forever. So most times he holds stocks that pays him royalties. Now, the long-term strategy that you can use in playing in the crypto market is you can either do dollar cost. There are two. The long-term strategy, you can either do intermittent buying, or you do what is called dollar cost average. Now, you can either do intermittent buying or dollar cost average. And what is intermittent dollar cost average? Sorry, I used averaging. Dollar cost average, DCA. Um, Intermittent buying is when you buy a fixed amount of crypto at fixed time intervals. Now you can say, okay, every month I'm going to be buying $20 worth of Bitcoin or $20 worth of Ethereum, and you stick to it every month. You don't care what the price of Bitcoin is. You don't care. You just keep buying, you just keep buying, you just keep buying. That's intermittent buying. You can also call it is similar to buy and hold. Then intermittent buying is similar to dollar cost averaging, but there's a very slight difference. Dollar cost averaging is a strategy where an investor invests a total sum of money in small increments over time instead of all at once. The goal is to take advantage of market downturns without risking too much capital at any given time. Now, the goal is to take advantage of market downturns. So that tells you that for dollar cost averaging, the best time to use dollar cost averaging is when prices are going down the way they are now. That is the best time to use dollar cost averaging when prices are going down and you're not sure how much lower they will go. So usually price moves in waves. In the downtrend, you have the impulse wave down, you have a corrective wave, a impulse wave, corrective wave, impulse wave, corrective wave. But overall, the direction is down. That's how prices move. Now, so your dollar cost averaging now helps you not to be concerned with the one you bought here. Then it comes down, goes up, comes down, then you bought here, it goes down. So if you're not doing dollar cost averaging and you bought here, you'll be afraid that it's going down. But since you're doing dollar cost averaging, in fact, you'll be happy. Why? Because it now gives you opportunity to average your position size or your entry price. So if it goes down, you buy. Goes down again, you buy. Usually there's a formula that big traders use, meaning if you buy here, it goes down by 15%, you buy again. It goes down by another 15%, you buy again. It goes down by another 15%, you buy again, until you fully used all the money you've allocated for this. So that's what you do. And the reason why they fix a fixed sorry, why they use a fixed percentage drop is because you don't want to be arguing with yourself when it drops by another 15%. When it drops lower, you don't want to be thinking, oh, is this the low or will it go lower? Your strategy says once it drops low by this percent, you could set 20% or even 10%. Once it drops lower, that's for traditional stocks because they don't move that much. But in crypto, dropping 20% or 30% is very, very common. So your margin should be larger. You could say anytime it drops 20%, I'm going to buy. Drops another 20%, you buy. Drops another 20 until you exhaust the capital you've allocated. Now, the difference between these two is that in dollar cost averaging, you already have an estimate of the amount you are willing to invest. You already know that, okay, I'm going to invest $1,000 or, yeah, $1,000, but I want to do it over a period of 6 months. So 6 months, you're monitoring the price. When it goes down, you buy. When it goes down, you buy. When it ranges, you still buy like that, like that, like that, like until you allocate fully use out of this $1,000. You could say for this period of, let's say, 4 months. For this period of 4 months, I'm going to be spending $250 every month as Bitcoin keeps going lower on buying Bitcoin. So that's dollar cost averaging. Unlike intermittent buying, if price is going up, you're buying, going sideways, you're buying, go down, you're buying. Why? Because for intermittent, you don't care about the price. You just want to own a piece of the asset. Now let's go on. Okay, let's go on. Okay. Okay, these are the long-term strategies. Then who can apply this strategy? Now, this strategy, even though it's nice and cool, it cannot be applied by everybody. It cannot be applied by everybody because the reason is a lot of us know how the Nigerian economy is. The economy is such that a lot of graduates don't even have jobs or access to jobs. So if you don't have a job or have a business that pays you steady money or that gives you a good cash flow at the end of every month or every week, then it will be very hard for you to do long-term investment strategies. Why? People who are looking for, still trying to meet their basic needs, put a roof over their head, buy food, clothing, it's hard to invest, really, really hard. So you can only now start thinking of investment if you have a fixed income or you have a business that generates cash flow for you on a weekly or monthly basis, or maybe you got a huge inheritance. So even though right now you don't have a job, you've not started a business, you have a huge inheritance that, okay, you can afford to even live the next 10 or 20 years on that inheritance, or maybe the next 5 years, or even the next 3 years on that inheritance without working, or on that savings without working, or maybe you sold the property, you can now live without working ahead, then you can do this long-term investment strategy. That's the first point. Then the second point is Okay, how do you do it? The first step is to try and build confidence in whatever asset you're buying. And the only way you can build confidence is to do thorough research. For example, Bitcoin is not going anywhere in the next 50 years or maybe even more. Bitcoin is only about 10 years old. So when some of us are, I'm in my 30s, so when some of us are maybe even 90 years old, Bitcoin will still be in existence. Okay, 80 years old, Bitcoin will still be in existence. So it's actually a long-term thing, and the price can only get higher. Why? Because Bitcoin is designed to be deflationary. The inflation is very, very small, in that you can almost say it's deflationary. Then it has a good store of value. Nobody can hack it, nobody can control it or take over it. So that gives you enough confidence that no matter what, even if the price crashes heavily, it will still go up. There are other coins like that in the market. Ethereum, they will always be there. Why? They've become, those coins have become bigger than themselves. So after doing that research and having that kind of confidence, now you do the research across different ecosystems. If you attended the MOC class, we treated ecosystems. So that should refresh your brain. Now, after doing that research, you settle for the coins that have strong, valid use cases, that have a functional team or a very large community. Now, after you've done that, there will be lots of coins. See, there will be so much coins for you to buy. Now, the next difficulty comes from reducing or overcoming what is called the paradox of choice. Paradox of choice comes into play when you have to make a decision and you have too many options. Having too many options can become a problem now, because now you are paralyzed. Which one do I pick? Which one do I leave out? Anyone you're leaving out, you're feeling like this one I'm leaving out might actually be the next big thing, and I'm leaving it out. So you're not sure. So you now be tempted to now spread, let's say you're investing $1,000, you now be tempted to now, over a period of time, to now spread your $1,000 on 50 coins. That gives you only 20, 20, 20, $20 per coin. And that it will be stressful to manage 50 coins. So you now have to decide, I'm just going to pick a few, maybe 5, maybe 10, but not more than 10. Why? Because you don't want to stress. The more coins you have, the more difficult it is for you to manage. Why? Because at some point you will have to cash in your investment. So if you have too many coins, in fact, some of them you even forget their names. When they are pumping, you don't even know. Now let's continue. So you narrow the list down as much as possible. In the army, they say fast is slow and slow is fast. They also say less is more and more is less. Those kind of rhyme. Less is more means the less coins you have, the less investment figures. I'm sorry, the investment assets you have in a portfolio. Of course, they preach diversification across different sectors. But then if you now hold too many assets like 50, 100, 200. I know someone that owns like 90 different coins. And I'm like, how do you manage all this? So don't go through that trouble. Eliminate them. Just pick the few ones you'll be working with. Then decide how much of your income you want to put into it. And that money has to be something small that will not affect your lifestyle, even if it takes 5 years for the investment to materialize. So that the money you're investing has to be small, something that you can do without. So if your salary is, say, let's say 500K, or let me be general, let's say your salary is 100,000 naira, 10% is 10K. For a lot of people, 10% is still a lot of money. So let's say 5%, 5K. Now that 5K is something that that's what you use for data. So 5K, I'll go into the market and buy 5K is $10, and buy $10 worth of crypto. And you decide which crypto you want. And at the end of every month, once you get your salary, or once you have done your balancing of your business and you say, okay, you're in profit, you take that $10, you pay yourself, then you go and use it to buy crypto, the ones you had already marked that you'll be buying for this investment. Now, the next thing is, okay, now you now need to look at what makes this strategy work. The reason why a lot of people invest badly, I know people who in 2017 bought Bitcoin at $20,000. Then when it was going to $3,000, oh sorry, they bought Bitcoin around $16,000 with a lot of money, a lot. In fact, the guy used as high as I think 40 million naira. So when it started going down, he panicked because he watched it from around $16,000 that he bought 2017. In 2018, it went as low as $6,000. Then eventually, even still went back as low as $3,000. So when the thing got to $6,000, this guy couldn't take it anymore. So he sold at a heavy loss. Heavy loss. Why? The reason because he couldn't withstand it anymore. So he sold. He sold at a loss. Why? Emotional detachment. He had emotional detachment to it. Now, the way to overcome that emotional detachment is by doing long-term investing or position sizing. Now, that would be 10-10. If that guy only invested a small amount of money, even if it's going down, you cannot panic. In fact, you'll be buying more. Why? You don't care. The money you're putting in is so small that it won't affect your lifestyle. It won't change anything about you. So the emotional attachment to that money is reduced to the barest minimum. Then by doing that, you overcome the four fears that people experience in trading. The first one is the fear of missing out, the fear of losing money, the fear of being wrong about your investment, or greed. Greed is the fear of losing money in a trade or in an investment. That is greed. And the reason why a lot of people who bought Bitcoin this year around $20,000 didn't sell at $60,000 was because of greed. What we call fear of leaving money in the trade or fear of leaving money in the trade. Greed. They didn't sell. So with dollar cost averaging, you overcome all these fears. And once those fears are overcome, you've been able to overcome that, then you can now trade or invest properly the way you should. Now, let's look at some of the coins that I have highlighted that you can look on. That I am personally looking at. Then there's a new set too, but I didn't put that here. Maybe I'll make it available sometimes. So they're now looking at investing coins by different ecosystems. This is not conclusive, but like I said, if you want to touch every area, you get frustrated in the end. Why? Because there are too many coins out there. So I didn't put Bitcoin here because, of course, Bitcoin is the Oga boss. When Bitcoin moves, all these other ones move. Sometimes with a greater percentage gain. So people who don't have so much capital to invest tend to focus on altcoins. So the first on my list is CX, which means centralized exchange, the tokens of centralized exchanges. So Binance, FTT, Huobi, OKX, Gate.io, Crypto.com, those are centralized exchanges. Then decentralized exchanges. And why centralized exchanges? They have come to stay. Those exchanges are making money. Yeah, in the course of time, a few of them will collapse, but the top ones we kept getting bigger and bigger as more and more people come into cryptocurrency. Yes, they'll get to a point where they just plateau, where they don't move that fast, others overtake like that. That's what happens. I beg your pardon, guys. Let me take some water. Okay, centralized exchanges, they are running a business, they're making profit. So they want to keep it going. They've grown this big. Nobody starts a business that big and then allows it to just fizzle away. Then the next one is DEX, decentralized exchanges. Sushi, Uniswap, PancakeSwap, Serum, 1inch, Index. So these are the different ecosystems. Then you have blockchains or platforms: Ethereum, ADA, Solana, Matic, Dot. Okay, I didn't add Dot. Polkadot. You have Dot, then under Dot you have Kusama and the rest. Kusama, Sora, so these are good places to look at too. So here now you can now decide which ones do I pick out of here. If it's just one you can pick. Don't bother yourself with trying to have so much. Why? Because it makes no sense that you have only $1,000 and you split $1,000 across 50 coins. Even 20 for me is too much. Just narrow it down, maximum of 10. Staking coins, FTT, Binance coins. Now, these ones have an advantage in the sense that even while you're staking them, you can still be earning some money while you wait for the 1 year or 2 years or 3 years or whatever time frame you have decided that you're going to be waiting for. Then, of course, you have DeFi. Lots of coins in DeFi. I've only put these few ones: Eve, Comp, CRV, Link, MDEX appeared here too. Let me take it out from here. Eve. Then, of course, you have NFTs. NFTs, you have Luxo, Eternity Chain, Rarible, uh, Axie Infinity, you have Flow, you have Z Chains or Chileans, CSD. So these coins that I've listed, what you can now do is you can now decide that, okay, you can now narrow it down. I'm not going to do that for you. You will do that by yourself. Okay, out of these coins, I'm going to pick two here, one here, or two here, two here, two here. That's four. Okay, some of these are replicated here, so you leave this out, or pick one that's not replicated, maybe dot, or Matic. Then you pick, of course, these coins that you have here, you can stake them. Then you pick one DeFi token, one of them here. Then you pick one NFT. That's simple. Just pick one. It doesn't have, don't try to bother about which one. Do you understand? These ones that I have here, based on my research, these are very good. These are very good. So just pick a few. So if you have like 10, you can say, okay, or five, narrow it down, maybe five. You can say, okay, and every month, maybe my salary is 100K. So every month I'm going to be putting, let's say 10K across these different coins. So what do? You now keep buying. You might say, okay, for the first month, I'm going to buy these two. Then the next month I buy these two. The following month I buy another two, like that, like that. You keep doing it like that. What are you doing? You're accumulating gradually with a small amount of money that will not make you emotionally attached. And once you are not emotionally detached, you can now be calm, make nice choices irrespective of what the market is doing in the short term. Irrespective of what the market is doing in the short time. Now, having said that, okay, we'll stay here. Having said that, you now plan, okay, I'm going to hold this for 1 year, 2 years, or I'm going to hold it until maybe I get 10x or 20x or 30x. Then you can also say, okay, I'll be taking profit gradually as this market goes in my favor. I'll be taking profit gradually. Why? Because we don't know at what point market gets to and suddenly start reversing or starts correcting. But then you want to be in the move and catch the big moves. Thank you guys for joining. I hope you got value from this training. See you in the next one.